Let us help you reach your peak in retirement. It's time for Retirement Elevated with Sean Lee.
Hey everybody, welcome into the podcast. Thanks for tuning in to the show. We always appreciate your time here while we talk about investing, finance, and retirement on Retirement Elevated with Sean Lee. Sean, buddy, what's going on? How are you, man?
It's starting to get some normalcy back to life, right? Hopefully
a little bit, yeah. Every state's a little bit different. We're able to have a somewhat normal conversation. Of course, we're still social distance and all that good stuff, but every state's a bit different. So at the time we're taping this, let's see, you guys, you actually, by the time we put this out, you guys might be free, or at least partially free anyway. So
yeah, we're going from red to dark orange, which means that you can sort of have some normalcy. And today because we're considered essential business, I'm here in the office for the first time in like 45 days, but I'm the only one here. There's nobody else here. Everybody's still virtual, and we'll still continue to do that quite a bit. We'll have skeleton crews in the office slowly but surely, and just making sure that everybody's safe and healthy as this continues on.
Yeah. Well, we hope that everybody's doing well, staying safe, staying sane, and we've got 5 ways the CARES Act could impact your retirement planning on today's podcast, so we won't dwell on the other part. We'll just jump into it and talk about a few of the things. We all know what's going on as far as the bug stuff, so we'll just kind of skip around some of these things and get right to some of the 5 items. First one being RMDs, those required minimum distributions. Give us the rundown on some things that have changed and some things to consider, Sean.
Yeah, so the CARES Act, as you know, is the Coronavirus Aid, Relief, and Economic Security Act. It's it's a stimulus deal. It's in essence to help individuals, businesses kind of get through this time. But they put some really cool things into this act that will apply to retirees, and this required minimum distributions one is kind of a big deal. This was the biggest related change, and what it did is that it suspended required minimum distributions for this year. And that includes 401ks, inherited accounts, 403bs, 457. So if you don't need the money, you don't have to take it. If you're over 70 and a half, or if you're turning 72 this year based on the changes to the Secure Act that they announced in December. And so that's the big one. You're not going to owe any RMDs in 2020, but you will have to still take those out in 2021. So they're not pushing them out that far.
But now you're not having to double up though, right, Sean? It's just 2021s you'll be responsible for, not like 2020 plus 2021s. Correct?
Right. It's just 2020. And here's the cool thing. So required minimum distributions are always based off of December 31st of the previous year. So the bad thing about this year is, the markets were still running pretty hard end of last year. So your balance December 31st, most likely higher than it is today. So you'd be forced to take money out at an inopportune time. However, if things continue and we don't see the recovery as quick, you'll see a potentially lower balance at the end of this year to pull your RMD out for next year. So it's great
pros and cons, right?
Yeah, that they're not forcing you to pull that money out if you don't need it. So it's a nice benefit.
Okay. Number 2 is 401k loans and other defined contribution plans. They've done some things here to help people who may or may not need to access this money a little differently.
Right. So 401k loans, usually what happens is that you can loan out 50% of your plan up to $50,000. So that you can usually take out a loan from your 401k. Now, this act made 2 big changes as it relates to that. First, plans now allow a participant to borrow up to 100% of their vested balance or $100,000, whichever is less. So if your balance is $80,000, you could take out all $80,000 in the form of a loan.
Okay.
And then secondly, the CARE Act gives people an extra year to pay back their loans if 2020 was one of the 5 years of their outstanding loan payment. So if you've got, you took a loan out in 2017 and your loan was due in 2022, it actually pushes it out to be due 2023 because now 2020 doesn't count.
Right. Okay, so again, folks, there's some good things in here, some pros and cons with things, but like anything, you want to make sure that if you're not clear on it or you're not sure what to do and you're not working with an advisor, definitely do so because you don't want to trip up and have any issues with this stuff. All right, number 3, Social Security benefits. What's changed here?
Not a lot. Social Security itself wasn't directly impacted by the pandemic. So, I mean, don't worry, your payments are still going to come. If you're collecting Social Security, you're still going to receive those benefits. But what did change is the employer side liability of federal Social Security taxes owed on wages. And so what happened is that the federal government said, you know what, as an employer, you do not owe your half of taxes on Social Security benefits from March 27th through December 31st of 2020. So in essence, what that means is that as an employer, I pay half of my employees' FICA Social Security tax. So it's 6.2%. And our employees, our staff, they pay 6.2%. So they pay their half. As an employee, you still have to pay your half, but as an employer, we no longer have to pay those benefits for the rest of the year for the employee.
Okay. So, and I know there's been some concern or confusion around like the stimulus checks. Some people are like, well, are people on Social Security who maybe only receive Social Security only getting those or not? And I believe they are getting those even if you just receive Social Security, like, because they were like, well, if you don't file taxes or whatever the case is. Mm-hmm. And I know some seniors who are living on only Social Security that have received those now at the end of the month. So they do seem to be going out. Yeah,
and the other side to that, another big concern is, will this pandemic put pressure on the Social Security trust funds that are supposedly on pace to run out of money by 2033, 2034?
Right.
Yeah, it could have a big impact on it, but the CARE Act says the trust funds, they're going to be backfilled during this time by general revenue. So it's not like the fund itself isn't going to be filled back up. General revenue is going to take care of that.
Interesting. All right. Well, we're talking here on the podcast about some of the CARES Act provisions, kind of going over this a little bit. And I think we've mentioned some of this stuff before, but we wanted to make sure we kind of get that information out there. It seems like every month brings new data. So it seems like almost every day brings new data, but it's certainly worth revisiting. New coronavirus-related distribution exception. That sounds like a mouthful. What do we got going on here?
Yeah, so normally what happens if you're under 59 and a half and you have an IRA, you need to pull money out, you have a 10% penalty. Or if you're under 55 and you've got an employer-sponsored plan, there's a 10% penalty. What this did is that this created an exemption or exception that if you pull money out from January 1st to December 31st of this year, and you or your spouse was diagnosed with COVID-19, or you had experienced adverse financial consequences caused by the virus, you were laid off or furloughed or whatever it may be, you have the ability to pull out up to $100,000 from your retirement accounts and not pay the 10% early withdrawal penalty. So if you're under 59 and a half and you experienced financial hardship due to this pandemic, you would not pay the 10% early withdrawal penalty on those distributions. And what is pretty cool about this as well is that the distribution will be automatically spread out over the next 3 years from a tax perspective as well.
Right, yeah, that's cool.
And so there's some things that, a little bit of leeway to allow the economy to continue to move forward. You're seeing a lot of industries change a little bit. I think this is, I hate to say this is a terrible, terrible thing that's happening in our country right now, but there is some massive opportunity for businesses to change and restructure and come out of this much better than they were before. When you look at any time in history that we've had something like this, whether it's Pearl Harbor or 9/11 or, the swine flu or, the market crash of 2008.
Right.
We've always come out stronger as a country.
A lot of huge companies actually formed in economic hard times. A lot of major companies through the last 100+ years have come out of there, and innovations and whatnot. So that's definitely true. It's, none of us ever thought we'd have to do this and wear masks and all this weird stuff that we've got going on. But, you got to try to find those brass rings where you can. That's for sure. Well, we said there was 5. There was one more, the charitable giving side. There's a few changes there as well.
Yeah, and the first one is, once you're over required minimum distribution age, you could do what's called a qualified charitable distribution. Well, if RMDs are suspended, you would think that, I can't do that anymore. However, they allowed that to maintain. So even though RMDs are suspended, you can still do a qualified charitable distribution of up to $100,000 from your IRA to a qualified charity in 2020. The direct distribution isn't going to show up as taxable income for the individual. But the downside to that is that since there are no required minimum distributions, it's not going to offset that for you.
Gotcha. Okay.
Second one is that just the CARES Act created a new above-line deduction of $300 for charitable contributions. So you make a contribution, it's an above-line tax deduction before standard deductions and exemptions. And then the third is that the CARES Act allows for cash gifts to most public charities of up to $100,000 of adjusted gross income in 2020. So the change there is that it's normally limited to $60,000 of adjusted gross, but now you can give cash gifts of up to $100,000.
Okay. All right. So quite a few changes in there, and so easily there's some things that you can identify as being some good pieces that you may want to take advantage of, but you also still want to make sure that you are running this past your advisor if you've got a plan in place, so to see how it may or may not affect you. Hopefully, if you're working with an advisor that's not Sean, then they've already reached out to you and talked to you about some of this stuff. If they haven't, definitely reach out to Sean and let him know, and him and the team will be happy to talk with you about some of these changes. So that's going to do it for us, I think, this go around on the podcast. But if you do have those questions or concerns, before you take any action, you should always check with a qualified professional like the folks at Elevated Retirement Group. You can call them at 855-507-3847. That's 855-507-3847. Or you can go to elevatemyretirement.com. That's elevatemyretirement.com. And, just click on the podcast page, subscribe to the show. We'd certainly appreciate it. You can get it on Apple or Google or Spotify or whatever platform you choose. More and more people the numbers are climbing higher and higher for podcast users over the last month. So I guess there's another little bonus, supposedly, I guess, from at least what we do anyway. So reach out to us, subscribe to it. If you're on Apple, that's your platform of choice. Just type in Retirement Elevated. You can find it and hit the subscribe button. Or like I said, you can go to Sean's website, elevatemyretirement.com. Sean, my friend, stay safe, stay sane, and we'll talk soon.
Thanks, man. You do the same.
I appreciate you here on the program. This is Retirement Elevated Podcast with Sean Lee.
Investment advisory services offered through Elevated Capital Advisors, LLC, and SEC